If you want to understand where the reverse mortgage industry may be heading this year, then we need to look to two things, and that is the housing market and also the traditional or forward mortgage lending space. And with that in mind, we're going to look at a recent column from Housing Wire that addresses the recent executive orders issued by President Trump to help address the affordability crisis. We'll dive into that and we'll see if these, in fact, will actually help increase inventory and lower home prices. Just a little over a week ago, President Trump announced two executive orders which aim to increase the housing supply and make consumer access to mortgage credit easier. And one of those directs the federal agencies, including the U.S. Department of Housing and Urban Development and also the Federal Housing Finance Agency, to work together in reviewing and also revising a number of regulations related to permitting and the construction of new homes. Another significant change noted in the executive orders is the broadening or the widening of the definition of a qualified mortgage. That would be accomplished through the CFPB or the Consumer Financial Protection Bureau. It would create tailored capital requirements for all banks, including community banks, and modernize appraisal process by allowing for expanded use of AI-driven valuations. The first executive order is entitled Removing Regulatory Barriers to Affordable Home Construction. It directs agencies to scrutinize various environmental protection laws that could be leading to a reduction in new home construction and also increased home ownership costs, which include higher property tax and insurance burdens. These orders are in essence seeking to curtail or to eliminate regulations that the administration believes are driving up new home construction costs, and of course that is passed on to the home buyer. The second order is promoting access to mortgage credit, and it is looking to loosen lending standards, noting that community banks, generally institutions with fewer than $30 billion in assets, have been especially affected. The regulatory and rule changes have undermined community banks' businesses, concentrated credit and liquidity risk outside of the banking system, and resulted in reduced access to credit for some credit-worthy borrowers. The administration is also directing the CFPB to reform, that is Reg Z, which is the Truth in Lending Act, and to broaden safe harbor protections for portfolios. One would expect that these executive orders would be well received by the housing and mortgage industry, and so we're going to look to the Mortgage Bankers Association. Housing Wire notes President and CEO Bob Brooksmith released a statement. We agree with the administration's focus on addressing costly mortgage regulations that have increased cost and limited access to credit. The MBA believes that these benefits should be available to every consumer, no matter which lender they choose. While these reforms may make incremental or even substantial improvements to housing affordability, there is one issue that has not been addressed, which would free up significant housing inventory, and we address that in this week's edition of the Industry Leader Update, and it's something that is keeping many baby boomers and older homeowners stuck in place, which is having a significant impact on the number of available homes for sale, so be sure to check that out. In the last 2 years, we have seen a broad expansion of proprietary reverse mortgage loans, but also non-reverse mortgage loans, which are equity-based from several lenders. And one of those is HighTechLending. And I reached out to Eric Ellsworth to follow up on an interview we had last November with Eric and CEO and president of HighTechLending, David Peskin. And I wanted to know, how is the Equity Select, which they released last fall, catching traction with potential reverse mortgage borrowers, and what gaps may it fill? So for that, we go to our recently recorded interview with Eric. Eric, welcome back.
Hey, thanks, Shannon. Appreciate you having us.
Good to have you. You know, a lot of reverse mortgage professionals have learned in many years of experience that not everybody wants a reverse mortgage, a HECM or a proprietary, or if they do, they're not qualifying or they're falling out. Is there a role for equity-based loans in those situations? Because, we spoke earlier about that and it really kind of piqued my interest.
Yeah. Look, and that's partially why we built Equity Select is, I think I've been in the mortgage industry 24 years and reverse mortgages 18 years. And, over the last 18 years, I've had clients and loan officers, account executives. Sometimes it's not always the right product, right? Or the client's averse just to the term of reverse mortgage. So we've come up with a product, as you know, Equity Select, that is not a reverse mortgage. It's a home equity line of credit that's a first and second position home equity line of credit that actually fills a lot of those gaps for those reverse mortgage clients that may be opposed to a reverse out of the gates, or they don't qualify. And I think there's a few different examples of that, Shannon. The first being closing costs. I think we all know the cost of that FHA insurance, and if there's an origination fee and third party costs, the upfront costs of a HECM sometimes can be perceived as high, not knowing what those costs are for a consumer. And then even some of the proprietary reverse mortgages that are out there. And we've run some scenarios where we've seen Equity Select be a third of the cost of a HECM and over half the cost of a proprietary loan in certain circumstances. So that's one of the areas where Equity Select shines, is if a client is averse to high upfront costs. The second where we've seen Equity Select really fill the gap is a lot of times homeowners have heirs, and us reverse mortgage advisors, I still put myself in that category. I love the product. Yeah. But there's sometimes when the homeowner wants to leave as much equity left over for the heirs, if they're projecting out 5, 10, 20 years, and looking at an Equity Select versus a proprietary reverse product. We have examples where we've shown clients just by making a small monthly payment, right? Just a tiny monthly payment towards Equity Select and a mandatory small monthly payment. Over the course of 20 years, there could be an additional $500,000 in some instances for the estate and the heirs to benefit from. So not only can you help the homeowner today by increasing their cash flow and lowering their payments significantly, but you're also preserving equity for the heirs and the estate in the future. And we find that to be a really great, healthy conversation for the client. A lot of times when we're showing them both Equity Select and a reverse mortgage, it just gives them the option, and they can see what they both look like now and also in the future. The other one is when a reverse mortgage is short to close because of a set aside. And sometimes when there's a set aside, it eats into the proceeds so much so that the loan becomes short to close. Sure. With Equity Select, if somebody's late on their taxes or their insurance, and this is true for all traditional forward loans, there's no set aside required. You would, in that instance, we would just make sure that they come current at closing, and we'd proceed with the loan. So we can take somebody that's trying to get a reverse mortgage, whereas before Equity Select, they'd walk away because they were short to close because they were requiring a LISA and maybe wait a couple years. They could take advantage today by increasing their cash flow by switching over to Equity Select, not being short to close, and access the cash that they need from the equity of their home. Just a few others here too, Shannon. One, non-borrowing spouse. Sometimes there's some strict guidelines on reverse mortgages with non-borrowing spouse. With Equity Select, if somebody's on, and we see this, somebody's on a second or a third marriage, and the new spouse is not on the title of the home, nor do they want them to be, and they've never been on title of the property, we can still move forward and use the age of just the homeowner and put the loan just in the homeowner's name. So that tends to be an advantage for those circumstances. And then also, our product is available to anybody 18 years and older. So you don't have to be 62 or on some of the proprietary products in certain states, they go down to 55. Obviously, it still is age-based loan to value. So the older you are, the more money you're going to qualify for. But we have had instances where a 45-year-old can benefit from Equity Select.
What are you finding as far as the need for cash? A lot of reverse mortgage borrowers are needing a big payoff of an existing mortgage, or they want a big chunk of money. How does Equity Select fit into that matrix? or that
You
type of
know,
borrower?
yeah, you know, it's been great, Chance. We've been able to tap into, you know, outside of the reverse market, you've got this massive home equity line of credit market,
Yeah.
and one of the largest reasons homeowners today are getting a home equity line of credit is debt consolidation because of the credit card debt that homeowners are racking up today. So we're actually seeing a lot of people inquire to lower the interest on, you know, some of these are 22, 25% interest credit cards. And by consolidating those into a product like Equity Select, we're seeing that. We're seeing home improvements. That's a big reason. Home modifications, home improvements for a homeowner that hasn't updated their property in 40, 50 years. When, you know, previously they weren't able to access, or actually before, they wouldn't even consider a home equity line of credit and they never wanted to get a reverse mortgage. They're excited to learn the ultra low payment that Equity Select gives them. And it finally a solution that allows them to tap into the equity of their home with a very low payment that they can afford.
And most notably, no payment shock like a HELOC has, and it recasts and fully amortizes.
That's right. That's what everybody likes to learn on a traditional HELOC after 5, 10 years. That payment goes from a principal and interest to a shorter term, or I'm sorry, from interest only to a shorter term principal and interest payment. And that payment shock is real. It happens. And a lot of people, you know, they can't afford or they struggle to afford that payment once that recast happens. Our product, there is a capped payment, a low cap payment that they can rest assured for the next 40 years. It's a 40-year term that they're never going to have to pay more than that required minimum capped payment.
Do you find a lot of the HELOC borrower, shoppers, I should say, are aware of the payment shock risk?
Not at all, right? I think, and
Wow.
it's unfortunate. I think it's in the paperwork, and I think people just focus on that low interest only payment. They see that payment, even though the you know the payment is shown to them that it is going to recast in the paperwork. There's a lot of paperwork in doing a loan, and sometimes people are just unaware of that, and it catches them off guard. So when we're talking to clients and we bring that feature of Equity Select up, that it's no recast, we have to educate them, especially if they already have a HELOC, on what's going to happen. We see
Yeah.
that a lot.
They could just be years away from a payment shock.
That's right. That's right.
Excellent.
Yeah.
Well, it looks like there's more and more solutions in the marketplace today. Of course, you and I love HECMs. We love reverse mortgages, but you know, as we see the evolution in home equity lending, it's good to know that older homeowners and even young ones have options.
Yeah, look, and this is what I share with people all the time, and when we do webinars and we've been able to have speaking opportunities is if you're 62 and older, I'm passionate about reverse mortgages. That's the Cadillac, right? But let's face it, not every situation is the same. And our product is broader than just 62 and older. We can go all the way down to 18 and older. And I was speaking to one of our partners that offers the product, and he was sharing with me that he had a client who, and he runs into this all the time. I'm sure many of your listeners watch or experience this as well, where a customer, their kids get involved, right? And they tell mom and dad, or mom or dad, that you know a reverse mortgage is not a good. They're not really educated on the product, and they tell them, hey, don't get a reverse mortgage, and they don't clearly understand what the product can actually do for them. And the partner said, hey, look, previous to Equity Select, I used to walk away and that client didn't have a solution, right? And now when I speak to the homeowners that the kids get involved and they're passionate about their kids not getting a reverse mortgage, and I share with them Equity Select, the homeowner walks away with a cash flow increase because they lower their payments so significantly and able to tap into the equity of their home. Whereas previously he'd walk away and there was no solution, and that senior homeowner would continue to struggle. So really exciting to see where this product is going and kind of just those different veins where the product has made a big impact for these homeowners.
It certainly is. Eric, good to have you. Thanks for coming back.
You bet. Hey, thanks for having me, Shannon. Appreciate it.
Thank you. And our last story also comes from Housing Wire, and I think perhaps that reverse mortgage professionals may be interested because it addresses not only home renovations, which are needed to age in place, but also the financing of ADUs or accessory dwelling units. And there's a very interesting angle with ADUs and aging in place. So for that, let's go to Housing Wire's recent column. It says, Block Renovations' Julie Kafitz on aging in place in renovations and ADUs. Kafitz cites that more than $500 billion is spent each year on renovations, and ADU rule changes across the country are making significant changes. Kafitz and her company, Block Renovation, are seeking to simplify the process, and they bill themselves as an Airbnb for home renovations. The CEO recently sat down with Housing Wire's Reverse Mortgage Daily to discuss renovation trends and the burgeoning market for ADUs, another option for seniors who are not getting the most out of their living space. The column notes that renovation costs are second to the purchase of a home, and many older homeowners, of course, are not construction or renovation experts, so they do need expertise and guidance when it comes to that. They have no idea about the actual work which needs to be done, plumbing, electrical, etc. They have no idea how much things should cost. And using AI tools, her firm looks at three things. That is the available space, the plan, and budgeting. Then we have the increasing popularity of ADUs. They're expanding all across the nation. And the article addresses how ADUs can be built by the adult children. So the parents who need assistance in their daily activities could move in with the children, but not in the house. They could be simply just a few feet away. But that got me to think about another proposed use or utility of ADUs. And that is to have the older homeowner build an ADU so a family member can help them with their non-medical needs and assist them in daily activities. Kafitz notes that the reforms in ADU regulations began mostly in California, noting in the early days they had 30% of all ADUs in the nation, and then Oregon and Washington came on board. Now, almost 20 states have passed laws to make accessory dwelling units more compliant and essentially legalize them. The most successful reverse mortgage professionals are not focused on selling loans. What they're focused on is solving problems. And what that allows is a more holistic approach looking at not only cash flow, but also aging in place concerns and potential solutions. And one could be partnering with a renovation firm who is working with several older homeowners who do need funds and need to tap into their equity without impacting their monthly cash flow. Just a little food for thought.